p.m. is my time with you, as always. And let's look at our website. Hey folks, have you ever gone to our website to look at what we have? And on our website, there is a button called appointment. And if you really want to see us, one of the partners, and you can come over here to see us. And you literally can book my time and then go in to see what I have available. So these are the first day I have available is on the 28th. So these are the time available. So same thing, right? You can go to see any one of us other than just me. So make sure you utilize our appointment button. It is a paid service, however, and when you come to us and you want to be so prepared and know exactly what you want to get an answer for, and I promise you will never disappoint anybody because we do have the answer for you. Of course, all of the webinars we do, like today, we're going to talk about construction company year-end accounting and how are you going to prepare yourself to file your taxes, right? Maybe you're paying a lot of taxes. It has nothing to do with your tax preparer. Has a lot to do with how you are doing your accounting. So that's why we're talking about accounting. And a lot of business people thinking accounting is addendum. It is like afterthought. It is not something they cares. It's like less important. I'm telling you, accounting is so important. If you do it right, you won't pay so much taxes like what you do right now. And this is our YouTube channel. All of the things we talk about and the things we planned out for the past 4 or 5 years. We have like over 1,000 videos in here. And this is the knowledge bank. The only difference between the knowledge elsewhere and the knowledge here at Community CPA, because we are the ones serving the small, medium-sized businesses. If you are a small business, sure, you can pay big buck and go to somewhere and get services way out of your league, or you can come to someone like us with a lot of experiences to serve people just like you. And that's where you're going to find in our knowledge bank, because the knowledge are just for you, not for people like Elon Musk, certainly not for President Trump's business, but it is for business like yours. All right, so with that said, let's just go ahead, start our journey on the prepared materials I gave you today. So if you see our topic today, my name is Ying. I am the managing partner and also the CEO of Community CPA. And we have a lot of history here. I founded the company back in 1998. You know, the more years you talk about these years, you realize how old you're getting. Because 1998, it was so yesterday, and I didn't feel it was a long time ago, but it is. Now I have clients who literally are doing great business, but they are born like around that time. Are you kidding me? And the people really do grow up, time do go by. And so you even start seeing people born in that time, like when the firms was established. So of course, and my bragging point for our firm is that we are not the firm that bought other firms and become big. And we are a full firm that organically grow up to this point. And we are really the one had a name out there. People know to come to us and they know how great we are. And I served on the National Taxpayer Advocacy Panel, a federal advisory committee to IRS for 3 years. So there you go. That's our website again. And I am an author. I wrote this book in front of you, Appointment with Ying at 8 a.m. And I also, oh yeah, it's right here. I got it with me. See, that's the first book I wrote. And this is the second book I wrote. It's already on Amazon, folks, if you want to see. And the second book I have, it is all about, the first book is about starting up a business. The second book is growing the business. So these two books are on Amazon right now, and I am working on getting the audio version out for the second book, but we have the first book in audio version. So I hope that you will be subscribing to our book and buying our book and subscribing to our YouTube channel. All right, No responsibility disclaimer. It just says that the webinar we put on here is free. And it is for you to learn the knowledge that you maybe do not know. But it's not for you to act upon it seriously. So you want to double check, triple check, and coming to engage us so we give you the right details and to get you to the right place. Or, and you can take our information, go to attorneys and your CPAs and say, hey, you know, what do you think? And can we do that? So becoming a starting point for you to looking for more suitable services for your business, right? So today's topic though, and I want you to know the options you have. With that, maybe you can consider to upgrade your accounting so you can get to the point where you don't pay tips to IRS, you don't overpay your taxes and not even know. So selecting accounting method for construction business is very important. You may ask me that, well, what do you mean? What do you mean? I just have my income, I have an expense. What do you mean I need to select accounting method? Hear me right here. So let's say, let's see what you feel after this webinar. So accounting method for construction company, the most popular or most used ones and the most correct ones, accepted by all kind of government agencies and your bank and all that, is what we call the completion method. It's a PCM in short, percentage completion method. Large contractors, and it should ensure that they use this reporting method for their accounting. So obviously, just by the word itself suggests, what does that mean? That means that if you are finishing your construction, let's say you have a $5 million construction job, and you finish 20% of it in year 2023. So with completion method, you will match your 20% of revenue with your 20% expenses and you go forward, right? So that is percentage completion method. It is required for most of the long-term project because IRS is not going to let you to report expenses all the time and no income. They want to see a completion method accounting is being used. Exception means that you don't have to do it. You may be a small construction company and you go like, Ying, never even heard of it. And what do you mean? I don't do it. That's okay. You probably fit the exceptions. So contractors are exempt from PCM method if at least 80% of the construction costs are for homes and other dwellings with 4 or fewer units. You see? Right? So if you're home builders and you don't even need to worry about it because you are exempted from this method. Smaller contractors with revenue less than 25 million or less in last 3 years are also exempt from that IRS code 460. So what do you mean by 3 years? What we mean by is looking back 3 years. If your revenue is under 25 million, you don't have to worry about percentage completion method. And for short-term contracts, completed contract method can be used. So what is completed contract method? It just means that you're going to account everything at the end when you are done, right? Those are short-term projects, like maybe renovating the driveways. Of course, you're going to start saying $6,000 and you finish and then you bill, you subtract your bill, your revenue by all these expenses that you have related to that project. So that's what that is, right? So percentage method, completion method has exceptions. Exceptions can be all kind of these things, short-term and smaller contractors or home builders. Make sense? All right. Then what other accounting method you can choose? And we sort of touch base on that. Is a project and a contract method. So you go by project, you go by contract. So use completed contract method when it is not possible to determine percentage completion of the project. And the other one, cash method. Under this cash method, revenue is recognized only when cash is received. This approach works the best for smaller short-term projects, right? So now you kind of got a little taste of, okay, I'm a construction company, and what kind of accounting method should I be? So maybe very simple, your cash method. Or maybe it's a little more complicated because you got this large project, offers you $5 million, it's a long-term, 3 years project. Then in that case, maybe you should go for percentage completion method. And if you really want to stick with a project in the contract method, make sure you qualify the exemption from that, right? All right. So now, couple of things I want to mention in the construction area. A lot of times we have these things we knew. It is more like a retainage. You know, you hear people talking about that all the time. Oh, I have a retainage. Oh, you know, I have bills that I haven't really paid. So what are these? I just want to kind of hone in some concept here. So when you are doing construction work, you finished everything, and you're supposed to get $100,000 payment, but your customer told you that, oh no, Ying, I don't know whether you really did my work right. I like to keep 10% retainage and I pay you later after 3 months if nothing goes wrong. That happens all the time. But on your book, what did you do? You know, are you going to count that as your income already, or no? Is that a receivable for me? How do I account that? So if you are a small contractor, you're probably on the cash method, right? So if you're on the cash method, nothing to worry because you didn't receive it, so you should not account for that. But then you say that, well, can I account all the expenses that go with this project because I really already have all the expenses and 90% income is here. Project is done. Project is done. I just need my 10% to come back in 3 months later. So what we can tell you is that you can account your 90% of revenue, then you deduct all the expenses that are related to the project. Maybe because of that 10%, you didn't have net profit because you only just made 10%. If that's the case, your particular project on the cash method is zero. You didn't really have any profit, you don't pay taxes to IRS. But what happened to that 10% when it comes back to you? Then you will book that as your income because that income has nothing to deduct because you already deduct all the expenses that earlier, right? So that will come in just as pure income and you're gonna pay taxes on the 10% of revenue that you just received. So that is the retainage story for small business owner. But what about liability? So overbilling liability happens. So when you are doing a project, you say that, well, $6,000 driveway project, and I want you to pay me 50% on the first day. Then when I finish, you pay me the other 40%. Then 3 months later, you pay me the 10% retainage, right? So you had that deal. So as a contractor, you got your 50% payment already, and you were just buying material. You haven't really started. You just use that money to, purchase things, obviously. And you got the $3,000, but your material purchase is only $500. So you are actually owes the customer the $2,500 because you haven't even do anything yet. And if you are about to close your book right now, then what you have is you have liability. You don't have the $3,000 as your income because you didn't even earn it yet. You just bought $5,000 materials, so that $5,000 is your real expense, and so you have income for the $3,000, so you can deduct $500 income offset $500 material because you haven't even put a penny on the labor and the year closed. So you should have a $2,500 on payables where you actually owe your customer. Yeah, you did got that money in your bank account, but it's not your income because you didn't earn it, right? Because you haven't really even started. So this is where the overbilling liabilities comes in on your balance sheet and contract retainage on your balance sheet. So contract retainage normally is a receivable and the other liability is a payable. So these are the things I want to address that right here because it's somewhat related to your accounting. When you are doing whatever accounting method you are taking, then you have to deal with these concepts. Of course, I just want to wrap up today a short talk with business expenses, particularly true to the construction area, right? You have your labor cost, and of course you know that your managers, your foremen on the field, they are your cost as well. Equipment, machinery, and right here I want to mention to you that some equipment, machinery you bought, you're really gonna use it in this project and also use it in another project. You are not just buying the equipment for just this project. But let's say you got equipment you bought, but it's only for this project. After this project is done, the equipment will be digested, like it will be bad, only one-time use or something like that. Then they will be treated as part of your cost, part of your expense deduction. But if it is equipment you bought, you're going to use it for the next 10 years, 5 years, then there you go. That is your asset. Doesn't get directly offsetting your income other than the depreciation piece that you're going to bring in. We have other webinars talking about depreciation because there's so much knowledge right there. And some people say, well, Ying, I don't know you're saying is right because my accountant deducted all the equipment and machinery for me, just 100%. You may be right because before 2023 and for a couple of years we have this bonus depreciation and the people are taking those listed properties like those equipment and deduct them right away. Or you have section 179, you deduct them right away. So there are reasons why some of those are expensed right away, but from accounting standpoint, they are asset. So whatever tax rules you're applying to the asset, so they become your expense, but doesn't take away their nature of that thing. It's an asset, it's not your expenditure. Raw materials is your expenditure, right? And the permit cost, of course, you need to get permit license to do this. Liability to workers' compensation, so big deal for a construction company. I would encourage you to actually have the workers' compensation figured out and every month pays to the workers' compensation. Don't wait until the end of the year. They give you an assessment and tell you how much to pay. It's always so expensive, right? Legal fee, of course. Safety measures, those are needed. So those are typical construction expenses. So I know you're going to say that, Ying, I didn't really see you adding in food and entertainment and the things that I buy for my workers when they're on site. So those are expenses you need to figure out whether it's deductible or not, right? If your project is off-site and you even have your people living in the hotel, eating on company's book, those are legitimate expenses. But if your work is local work and you buy lunch for yourself or some work about lunch for themselves, those are not necessarily business deductible because they are not really, you eat lunch. It doesn't matter you work or you don't work, you eat lunch, right? You really only have this deductibility when these lunch were provided by the employer and for the benefit of the business. It's a necessity to the business. So with that said, I will conclude today's webinar. Remember, we are always here at 3 p.m. If you don't get to know what we talk about, that's because you did not subscribe to our YouTube channel. Go to YouTube channel, Community CPA, subscribe to our channel. Then you get notification from us, tell you what we talk before I show up here. And I want to see you again, and I hope you enjoy our short talk, and I hope to see you clicking, subscribing, thumbs up on our videos. I'll see you again on Saturday. Bye-bye.